Alex just got a raise, and for the first time, he's seriously considering buying a home. His friend Marcus recently closed on a house and has been talking about little else. Over lunch, Marcus tells him he's throwing money away on rent. Marcus isn't entirely wrong. Every month, Alex's rent goes to his landlord and disappears. There's no equity, no ownership, nothing to show for it after 12 months. What Alex doesn't see is the other side of Marcus's situation. Marcus's mortgage payment is $1,800 a month, up from his old rent of $1,200. On top of that, he pays property taxes, homeowner's insurance, and, last month, a $3,000 plumbing emergency that came directly out of his own pocket. Renting means someone else owns the problem. When the roof leaks, Alex makes a phone call, and it's handled. Ownership works differently. Every problem and every bill belongs to the homeowner. Renting also can't do one thing a mortgage does: build equity. For someone who moves frequently, hasn't built an emergency fund, or lives in a high-cost city with a thin down payment, renting is the more sensible choice. For someone settled in one city, with stable income, a proper down payment, and plans to stay at least 5 years, buying makes more sense. Alex has been putting $300 a month into his savings account for 2 years. That's $7,200 sitting safely in the bank, and he's proud of it. Then he checks the annual interest he earned, $25 on $7,200. His coworker Jamie mentions she put $5,000 into a simple index fund 3 years ago. It's now worth $7,100. She didn't actively manage it. She simply left it alone. Saving is the safe option. It's money Alex knows will be there. His emergency fund, next month's rent, a trip he's actually planning. A savings account protects money he'll need soon. The trade-off is inflation, which runs at around 3% a year, while Alex's savings account pays 0.4%. Every year, his $7,200 quietly loses purchasing power. It buys less gas, fewer groceries, and the smaller slice of rent than it did 12 months earlier. Investing puts that money to work. The stock market has historically returned around 7 to 10% annually over long periods. Alex's $7,200 invested and left alone for 30 years at 8% becomes roughly $72,000. The same amount sitting in a savings account might reach $9,000 over that time. Money needed within the next 1 to 3 years should stay saved, kept liquid and safe. Money that won't be touched for 5 years or more should be invested. Time is the only ingredient compound interest actually requires. Alex is at the register, reaching into his wallet, deciding between his credit card and his debit card. His debit card is simple. The money comes out immediately, so what he has is what he spends. There's no bill at the end of the month, and no surprises. His credit card works differently. He swipes it and nothing moves right away. Over the month he buys groceries, fills up his gas tank, and pays for dinner with friends, all on the card, and at the end of the month a single bill arrives covering everything. If Alex pays that bill in full every month, he earns free travel miles, 2% cash back on groceries, and purchase protection at no additional cost. The bank is effectively paying him to buy things he was already going to buy. Credit cards also build a credit score, the number that determines mortgage rates, car loan rates, and even whether a landlord approves a rental application. Debit cards don't affect that score at all. They simply spend what's already there. For someone who has carried a balance before, struggles with overspending, or is rebuilding after past debt, a debit card removes the risk entirely. For someone who pays their full balance every month without exception, a credit card used the same way as a debit card collects the rewards for free. Alex wants to invest. He opens a brokerage account and is met with thousands of options: Tesla, Apple, Amazon, Nvidia, an S&P 500 ETF. He has no idea where to start. His coworker tells him to buy Tesla because it's going to the moon. Alex has heard that phrase before, about a different stock, and watch that stock move the opposite direction. An ETF, short for Exchange Traded Fund, works like a basket. Instead of buying one company, Alex buys a small slice of 500 companies at once. If one of those companies fails completely, it barely affects the total, since the other 499 keep going. Buying individual stocks works differently. If Alex puts $1,000 into Tesla, and Tesla has a terrible year, his $1,000 has a terrible year along with it. Had he bought an S&P 500 ETF instead, That same bad year from Tesla would be one voice among 499 others. Individual stocks can return more. Someone who bought Apple in 2010 would be very pleased today. But for every Apple, there are dozens of companies that looked just as promising and went to zero. Picking the right one requires information, time, and a fair amount of luck. Warren Buffett, widely regarded as the most successful stock investor in history, has publicly recommended that most people, including his own heirs, put their money in a low-cost S&P 500 index fund rather than picking individual stocks. Someone who enjoys deep research, can handle significant volatility without panic selling, and wants to actively manage a portfolio may prefer individual stocks. Someone who wants consistent, diversified, long-term growth without spending hours on research is better served by ETFs, specifically low-cost index funds. The dealership has Alex's dream car on the lot, brand new, with a monthly payment of $589. A used version of nearly the same car, 3 years old, with the same features and the same engine, is available at a different lot for $14,000 less. The moment a new car leaves the dealership, it loses roughly 20% of its value. Within the first 5 years, most new cars lose 40 to 60% of what the buyer paid. By the time Alex reaches the end of his street, the car is already worth significantly less than what he paid for it. A used car has already absorbed that depreciation hit. Someone else took the loss. New cars do offer something in return: a full manufacturer warranty, the latest safety technology, and no mystery history. With a used car, Alex has to ask why it's for sale, whether it's been in an accident, and whether there's hidden mechanical damage no one has mentioned. Most advisors point to the sweet spot: a car that is 2 to 4 years old, past the steepest depreciation drop, but still recent enough to carry remaining warranty coverage and modern safety features. For someone prioritizing long-term cost and willing to handle the inspection process, a used car lets someone else absorb the depreciation. For someone who values reliability, warranty coverage, and the latest features more, a new car makes sense, provided the loan stays short, under 48 months, with a payment that's genuinely manageable. Alex just started investing $400 a month into an index fund, and the early progress feels good. Then, his laptop dies. Replacing it costs $900, and without the cash on hand, he puts it on his credit card. A few weeks later, his car needs new tires. Another $600, again on the credit card. 3 months in, Alex has $2,400 in credit card debt at 22% interest, and $2,600 in investments he can't touch without paying fees and taxes. He built a portfolio and a matching pile of debt at the same time. This is what happens when someone invests without an emergency fund in place first. The market doesn't pause because a car needs tires, and life doesn't wait for an investment plan to mature. When unexpected expenses hit with no cash buffer behind them, debt fills the gap, and it's usually expensive debt. Research shows that people with as little as $400 to $1,000 in accessible emergency savings are significantly less likely to take on high-interest debt during a financial disruption, even when that amount doesn't cover the full cost of the emergency. Anyone without 3 months of living expenses and accessible cash should build that emergency fund first, before investing another dollar. Once the fund is in place and fully stocked, everything extra above it can go toward investing. Alex's friend Jordan just quit his job to freelance, announcing a rate of $80 an hour and expecting to make far more than he did as a salaried employee. Jordan doesn't actually bill 40 hours a week. About 10 of those hours go to finding clients, writing proposals, chasing invoices, handling taxes, and managing his own admin, unpaid time. He also lost 2 weeks to illness, with no paid sick leave, and in October, he lost his biggest client and went 6 weeks without income. Jordan also pays self-employment tax, roughly 15%, on top of income tax, and buys his own health insurance at $500 a month. There's no 401k match, no paid vacation, no HR department, and no one to call when a client goes silent. Alex, meanwhile, has a stable paycheck, employer-covered health insurance, a 5% 401k match, paid vacation, sick days, and job protection. None of it looks as exciting as a big freelance rate, but once every benefit is added to the base salary, his total compensation is quietly higher than it appears. The average freelancer's effective hourly rate, once unpaid hours, taxes, benefits, and slow months are factored in, typically runs 30 to 40% lower than the rate quoted to clients. The freelancing tends to work best for someone with 6 or more months of savings as a runway, in-demand skills clients will pay for, and a genuine tolerance for income uncertainty. Employment suits someone who values predictability, benefits, a retirement match, and a clear career path, where the total package is worth more than the base salary alone suggests. Alex is buying a home, and the bank offers him 2 options. A fixed rate of 6.8% for 30 years, with the same payment every month for the life of the loan. A variable rate, starting at 5.2%, adjusting each year based on broader interest rates in the economy. The variable rate looks appealing at first. Alex's initial payment would be $300 cheaper per month, or $3,600 a year, adding up to $18,000 in savings over 5 years, compared to the fixed rate, assuming the rate never moves. Variable rates do move, though. Between 2022 and 2023, average variable mortgage rates in the U.S. rose by more than 4 percentage points in under 2 years. A fixed rate offers something no investment, saving strategy, or financial product can match: certainty. Alex's payment in month 1 is identical to his payment in month 300. With no exposure to economic conditions outside his control. Most financial advisors recommend fixed-rate mortgages for primary residences, since the payment certainty protects families from economic conditions they can't predict, control, or absorb at the wrong moment. For someone confident they'll sell or refinance within 5 to 7 years, and who fully understands the adjustment risk, a variable rate may save money, provided the savings are real and the risk is one they can actually absorb if rates move against them.